Hello and welcome to The Print. I'm TCA Sharad Raghavan, Deputy Editor, and today we're going to be discussing what's going to happen in the Q2 numbers that are going to be released at the end of this month. We're going to give you a little bit of a preview. Now, what everybody seems to be expecting is a slowdown. So, we're going to look into why this is, which are the sectors that are causing some pain, and possibly whether these are temporary effects or whether it reflects a larger structural slowdown. To discuss all of this, as always, we have with us Radhika Pandey, Associate Professor at NIPFP. Thank you so much, Radhika, for joining us.
Thank you, Sharad.
So now, Radhika, as I said, that everybody seems to be expecting that the Q2 numbers will be lower than initially expected. But how much lower? What is the outlook for Q2?
So, if we remember, the first quarter GDP numbers came in at 6.7%.
Right?
So, it's expected that the Q2 numbers would be marginally lower than the 6.7% number. So, it's expected to be somewhere between 6.2 to 6.5%, depending upon how the different sectors perform, because there are expectations of slowdown in consumption, there are expectation of slowdown. Investment has also not picked up as was expected to pick up in the
Right.
second quarter after the Q1 related election related slowdown. That
Right.
was on expected line, but in Q2 also it did pick up, but not on expected line, not at this very strong pace. So there are various headwinds, and therefore it is expected that the Q2 numbers would be lower than Q1 numbers. And again, as you rightly pointed out, the more important question is whether this is a cyclical slowdown or a structural slowdown. And that is something we will get to know when we have more months of data. Because as of now, at best, what we can say is that we are getting a mixed picture. Some sectors, some variables are showing better performance, some variables are not.
But the
Yeah.
thing is that even in Q1, the 6.7 was a unpleasant surprise. Nobody was expecting it to come in at 6.7. They were expecting slightly faster growth. And now if Q2 is also expected to come in slower, then there might be some deeper issues. But that, of course, will need more data to.
Yeah, so 6.7%, the good part was that the internal dynamics were quite favorable, because we talked about consumption revival, we talked about manufacturing posting a decent performance,
Right.
and mainly it was due to sharp cut in government expenditure due to elections and other cyclical factors. So, but now we need to see whether the slowdown in Q2 that we are seeing, whether it gets some effect is mitigated in October December because of the festive demand boost that is
Right.
expected, and whether that festive demand boost is sustained or whether it is just a temporary phenomenon. So that will all be seen when we have more monthly data. As of now, we have October, and October was is slightly better than what we saw in July to September.
Right. Okay. So now looking into the reasons why
Right.
growth is likely to be slower, let's start with the manufacturing sector.
Right.
What's the performance there been like?
Yeah. So when we talk about manufacturing, when we talk about the GV of manufacturing sector, what is looked at is, one is the performance of the listed companies in the manufacturing
Right.
sector, and the other is the index of industrial production manufacturing. So that gives us a sense of the volume, and the listed companies' performance will give a sense of the gross value addition
Right.
by the companies in the manufacturing sector. So now, when we look at the data from CMI Economic Outlook and CMI Provis, we see that the net sales of listed manufacturing companies reported only a meager growth of 1.79%, okay, in
Right.
the July-September quarter. So it gives us an indication that manufacturing sector performance might be a bit subdued in the second quarter when the official numbers are released, because they look at the MCA 21 database,
Right.
and we are looking at this database, but the trends are more or less similar.
Even the news reports are saying that profits in some sectors have actually contracted or
Yes.
they've been flat.
Absolutely. So, and when we talk about manufacturing, as I said, within manufacturing, some of the big sectors are chemicals and metal products. And metal and metal products have actually, the companies in metal and metal products have reported a contraction in sales.
Right.
primarily due to steel, because steel prices came down in July, September, and because there was less demand and there was also input cost pressure, so firms were not able to pass on the price pressure to the final consumers, so they took a hit on their balance sheet. So within metal and metal products, steel did not perform well. In chemicals and chemical products also, the sales growth are quite muted. And then if we look at consumer durable sector, there also we see that those sales are in double digit, but some of the sectors like personal care and effects, consumer electronics, they have reported subdued growth. Now, a part of it is also linked to heavy rainfall in the July September quarter in certain parts that led to lower demand for things like air conditioners and other electronics. But that is what I said, that we need to go beyond July September quarter, because to be sure, in July September quarter, some part was cyclical. There were other factors, like there was Sharad, there were heavy rainfall. So there were a number of factors. But overall, still, the data shows a sharp slowdown in sales, firstly. And then when we look at the other indicator, which is IIP manufacturing, the Index of Industrial Production Manufacturing, the data came out just on the 12th of this month. We see that it posted overall for the quarter as a whole, IIP growth is just 3.1%, which is one of the lowest since March 23. So again, IIP is not picking up. Sales of manufacturing companies are reporting weak numbers, and within manufacturing, the big constituents of the manufacturing segment as a whole, they haven't performed well. So we can say that manufacturing sector would report subdued growth. There would be some boost coming from deflator, but overall we see that when we talk in real terms, manufacturing sector is expected to report subdued growth.
Okay. And now a big push to growth since the pandemic has been government capital expenditure.
Correct, yes.
The government has been pumping in lots of money there, and it's been actually pumping up our growth. But what are the latest numbers? What was the numbers looking? We know that in Q1 it
Right.
wasn't that good because of the elections and the model code of conduct. But was Q2 any better? Did we see some growth?
So as we saw in Q1, the government capex contracted by 35%.
Right.
Now in Q2, there was a growth of 10%. If we look at July September quarter as a whole, we are talking
This is
about
growth over the previous
quarter, the July September quarter of last year. So year on year growth. July September quarter, central government capex reported a growth of 10%.
Okay.
But interestingly, what we see is, if we look at the July, August, September numbers, it's only in July that there was somewhere around 100% increase in capital expenditure.
I see.
And then August and September, actually, there is a contraction. So overall, we are getting a 10% growth mainly due to a sharp surge in capex that happened in the month of July, but August and September did not see a major increase. So what even the government is acknowledging that there has been kind of a spillage from Q1 to Q2. The sharp pace hasn't happened, and they are expecting that in the second half of the year, capital expenditure will pick up. But then it has to pick up substantially to meet the budgeted targets, and it has to increase by 50% in the second half, over the second half of last year, to meet the budgeted target. And same goes for states also. States have also not seen a very sharp increase in capital expenditure, and some of the bigger states, if we look at, say, Andhra Pradesh, Telangana, UP, Uttarakhand, they have actually reported a contraction in capital spending. So there are some states that have done better, but overall, when we see, even states have not shown a very sharp increase in capital expenditure. So both for the central government and states, they both would have to increase their capex by 50% each in order to achieve the budgeted targets of capital expenditure, which looks a bit difficult.
Absolutely.
And we've seen that government has liberalized, eased the cash management norms for Q4, so that there could be capital spending. There's no restriction that 25% has to be done in each quarter. So those cash management guidelines have been eased, but there is a need to look deeper into why capital expenditure is not picking up. Are we laying too much emphasis on sectors where there is less absorptive capacity and so on?
Right. Okay. And now Coming to yet another engine of growth, that's consumer demand,
Yes.
both urban and rural. What is that looking like? Because I mean, that tells you quite a lot about how people are doing.
Absolutely. So there we see that mostly the urban demand indicators are not doing well. It's the urban, the rural demand indicators which are still showing some better progress, some encouraging picture. But if we look at urban demand indicators, namely the auto sales, or if we look at the financial performance of fast moving consumer good companies,
Right.
all of them are showing that urban demand has not picked up and urban demand is weak. Now it's very interesting, Hindustan Unilever Limited, one company which is one of the biggest companies in the consumer goods segment, in their investor call conference, they noted that the demand in urban areas has been trending down.
Right.
And more concerning is the fact that they are seeing that demand in bigger cities has declined. It's the demand is still okay in rural areas and smaller cities, but demand in bigger cities has is trending down. So there is some structural shift happening on as far as the demand is concerned, and that needs to be seen whether this is just a temporary blip or there is more to it. But if we look at the various urban demand indicators, we do see a decline. Some of the indicators, for example, communication based indicators, do see some traction in the July September quarter, but overall we see that urban demand has not done well,
Right.
whereas rural demand is still okay. If we look at scooter sales, though it's not as high as the April to June quarter, but still good enough. But if we look at some of the other segments like commercial vehicles also did not do well,
This
mainly
is
because
rural.
rural, yes,
Right.
yeah. Commercial vehicle is generally we talk both urban, rural, but
Yeah.
again another indicator of demand and economic activity as such. And they did not do well mainly because the capital spending was lower,
Right.
and therefore the push to construction was lower. And if you have lesser construction activities happening, or there's some new subdued position there, commercial vehicle sales tend to take a hit.
Yeah.
And even the auto dealers are very worried because there the inventory level is as high as 80 to 85
Yes,
days.
it's piling up.
Yeah, it's piling up, and that was the case in September. October, thankfully, has done well due to festival demand, and it's expected that now with the wedding season kicking in, and they expect some numbers they have given 4.8 million weddings going to happen.
Right.
So there could be some increase, but overall, they're still worried about strategic inventory management, and that has to do with urban demand.
Right. Okay. Now this is all sounding very bleak. So let's look at exports.
Correct.
So how has India done on the exports front?
Yeah, so if we look at exports, again, if we look at the July September quarter, exports did not do well, but that was mainly due to oil exports. If we
Right.
remove oil exports, if we look at the non-oil exports, there was this growth of around 3.5 to 4%,
Which is not great,
which
but
is
it's at
not
least
great,
some
but it
growth.
is decent and it's
Yeah.
better as compared to the similar quarter of last year. But because oil exports occupy 17% of our overall exports, and oil prices were declining, and therefore oil exports declined, they suffered a contraction, and that had a bearing on overall export. But the outlook for exports doesn't look that great because now we have India Canada bilateral tension, we have West Asia,
Right.
we have so much economic uncertainty due to tariffs being
Canada is
imposed.
unlikely to be a large factor. We barely trade with them in any
Yeah,
large amount.
yes, we barely trade, but if we cumulatively look at, there has been intensification of economic uncertainty.
Right.
There has been, increase in the challenges on the external sector front after
Donald
Trump's
Trump has come. Yeah.
presidency. We need to see how exports will pan out once he assumed presidency. What will be the kind of tariffs? So export did not do that badly in the July September quarter, but the outlook looks uncertain with the various changes that we are seeing on the external sector front.
Okay, and now another factor that could have impacted growth, that does impact growth on every quarter, is the amount of bank credit
Right.
that's being given out. So, could you give us a little bit of a snapshot of what the banking sector looked like in Q2?
Yeah, so if you look at Q2, it's very interesting that public sector banks have done well again, and their the GNPA ratio, which is an indication of their asset quality, has shown further improvement broadly across all public sector banks. Capital position looks good. The only problem is now to be seen is on the net interest margin, which because now credit growth is declining, and that is if we look at the aggregate bank credit growth. Uh, July September quarter, the bank credit growth was 13%,
Right.
and the same quarter last year, bank credit growth was 20%. And the main reason now is that the typical drivers of bank credit that we spoke about in our earlier episode were personal retail personal loans, retail loans, and services, and both these segments are now showing weak growth, and that is having a bearing on the overall aggregate bank credit. Personal loans, we know that risk weights were increased, but despite that, till the month of May, personal loans were doing well. But now, what we are seeing, if we look at the quarterly financial performance of private sector banks, there is some evidence of stress emerging in the unsecured personal loan credit, mostly in the credit card business. So there is some delinquencies in the credit card loan, and that is something that would prompt banks to curb their exuberance as far as the unsecured retail loans is concerned, though they are high yielding, but now they are seeing problems. So there would be some recalibration in the portfolio of bank lending, and that would lead to a slower growth, which is like a more normal growth, because 20%
That
growth
was incredible.
that would have resulted in overheating. So we are moving to a more normal phase, and even the credit and deposit gap is now narrowing. We spoke about CD ratio being very high, and that is now narrowing. But the stress in the unsecured personal loan segment, which there are some early indications, that is something that need to be seen.
But lower credit means most likely lower growth in the economy as well.
Yes, yeah, that is also there. So that is something that needs to be seen, because that will have bearing on household indebtedness also. Because the main factor that is driving this delinquency is the credit card business and the microfinance lenders, not the others. So it has something to say about the household indebtedness also. So all these things would have a bearing on growth, certainly.
Right, okay. And so we have some questions from the audience. Saurabh asked, are we getting into a low growth, high unemployment, and high inflation phase because of reckless spending or welfareism, especially by the state governments?
So it's slightly early to say we are getting into a stagflation kind of phase, because, as I said, we need to still study the pattern of economic growth, because we have seen that July September quarter, certainly there is a slowdown, but whether this slowdown is temporary or whether it is sustained beyond the usual festival driven boost, that is something that we need to see. And similar is the case with the prices also, because we had this inflation data. We saw CPI rising above 6%, and that was expected, firstly due to unfavorable base effect, and secondly due to volatile vegetables. Vegetables played a big role this time in the October inflation number, even though their weight in the overall CPI is just 6%, but their contribution to inflation was almost 1/3. So so vegetable inflation led to high inflation. So we need to see what is the trajectory of core inflation and what happens to urban demand, and that would help us to assess whether this is stagflation or due to reckless spending on because when we talk about states, yes, there is a shift in the state's fiscal composition as well, because there is a greater emphasis on committed expenditure and then on subsidies rather than on capex, that we saw in our earlier episode as well.
Okay, and Karthik asks, now we've talked about how capital expenditure has come in lower, but he asks on the other side, what sorts of subsidies can the government cut back on?
Yeah, so there's a very interesting study that NIPFP did, which is on rationalization of subsidies by states. So what it says is that, firstly, as I said, committed expenditure, we've seen that it's almost like 50 to 60% of the revenue receipts of states is just taken over by three items: pensions, interest, and salaries. So as it is, the discretionary spending component is very lower, and within that also, if we are spending a lot on subsidies, what we need to first focus is on better focusing of better targeting of subsidies. So that is
Right.
one thing. And secondly, there are certain subsidies like free power supply. That is something that needs to be reconsidered, because that's having an impact on state electricity boards. We are pushing them into debt, and then another
Yes.
round of subsidies is given that will have an impact on the debt position of states. So that is one subsidy that needs to be considered. And the other part that could be considered is the interest subvention on loans that is given. And
Right.
that's the scale of interest subsidy is rising. The kind of transfers that are being given, before elections, we see all states are giving transfers to, payment to women voters, all women from 21 to 65 years of age. So we need to have more targeted subsidies, and we need to curb on these free power supply and a loan waiver to farmers. All these need to be cut down and have a very targeted focus, and that would help in improving the fiscal health of states.
Right. Okay. So there you go. I mean, the situation's not looking that great. The data for Q2 is most likely going to show a slowdown in the economy. That's because manufacturing, especially from the corporate side, the large corporates, they have not done well. Uh, Urban demand seems to be slumping. Then rural demand is doing slightly better, but even that was slower than in Q1. Then our exports did decently, but looking ahead, things are not looking great. Trump is the new president in the US. He's promised that he'd impose a lot of tariffs and things like that. Bank credit, that has also slowed down. Now, bank credit fuels a lot of growth in the economy. So, if that slows down, then growth also slows down. So, overall, the picture is not looking that great, but we don't yet know. There's not enough data to tell whether this is a cyclical thing or whether it's a structural weakness in the economy. But hopefully, it's only cyclical, because then, Q3, Q4 might be better, and then the next year might be even better. But we just have to wait and see. But on that note, that's all from us. Thank you so much for watching.